you are a 30-year veteran of the asset management world.
I am.
And you started your new firm, Aperture, about a year ago, just over a year. Mm-hmm. How long had you been thinking about this idea of linking pay to creating alpha?
That's a really good question, because it's been about 5 years in the making. You know, about 5, maybe even 6 years ago, I started thinking about what is it in the active space that is challenging performance so persistently? Because we know when we look at the large numbers across many different managers, and specifically U.S. equity managers, that managers don't perform net of fee. Mm-hmm. And I kept saying to myself, why is that? Is there a structural reason? Is there a cyclical reason? And ultimately, I came to the view that size really matters. And the more assets you have, the more challenging it is to perform. And the incentive system that the industry was based on for 50 years rewards size, mm-hmm. both to the PM and to the firm. Mm-hmm. And so if you wanted to actually change the probability of having good performance, you had to attack the incentive system.
And that's exactly what you did. So what kind of managers are you now recruiting at Aperture? What is their incentive for working at your firm versus a traditional mutual fund where they're not on the hook for a bad quarter or a bad year?
Yeah, great question, really good question, because you're getting at the heart of what Aperture is trying to change. The existing pool of managers are effectively an incentive system that produces adverse selection. You get paid whether or not you perform. Mm-hmm. Aperture is creating a pool of managers that has a positive selection bias. You get paid if you perform. There's a modest base fee and a modest base salary, but virtually all of the compensation to the manager comes from performance. So managers at Aperture really want to perform and believe they can perform and have a history of actually doing that.
Okay, so when we look at your first two funds, the Aperture Endeavor Equity Fund and the Aperture New World Opportunities Fund, you said there's a base management fee that's fairly modest, and then a performance fee once the fund outperforms its benchmark. 40 basis points, or 44 basis points in this case, is cheap for a mutual fund. It's in line with the average ETF. Of course, if you asset weight the fees for equity ETFs, that would be 15 basis points. So is this base management fee enough to keep investors from switching into passive products like an index fund or an ETF?
Yeah, great question again. So first of all, ETFs, as you know, because you're a specialist in them, are all different in different kinds of parts of the market. And so the Endeavor Equity Fund is focused on the global equity market. Mm-hmm. Lower ETF fees are usually in the U.S. large cap space. So if you look at the global equity market, the 32 basis points is basically the average of those fees. Secondly, ETFs have tracking errors. Tracking errors are really big deals. People don't talk about tracking errors. You don't actually get the index return. You get the index return minus the fee minus the tracking error. And in the case of the global equity world, that tracking error can be 30 to 35 basis points. So you're actually getting 32 basis points minus 35 basis points of tracking error if you buy the ETF, or 67 basis points through the index. Aperture says you pay us 32 basis points as the management fee, we have to beat the index to earn more money.
So I get what you're saying, but I wonder why not do all this and use the ETF wrapper? You talk about the tracking errors. Certainly there is that, but sometimes you can make it up with securities lending income. But in addition, ETFs are more tax efficient than a mutual fund. A chart that we have here shows that 65% of mutual funds paid capital gains versus, say, 7% of ETFs.
Yeah, just to make a point, the tracking error that I mentioned is net of the security lending revenue. So that's all the benefit. You know, it rolled into the tracking error, and it's still negative, and it's still significant. Now, as to the tax effects of mutual funds and tax effects of ETFs, it's definitely true that ETFs have a favorable tax treatment due to sort of an oddity in the tax law. How long that oddity stays in place, whether or not the IRS decides to actually investigate why mutual funds and ETFs are treated differently, is another question. But the main difference between an ETF and a mutual fund is that mutual funds are actively traded in the securities and ETFs generally are not. There are some ETFs that are actively traded, but they're complex and there's additional costs borne by the investor in order to achieve that. What would be interesting in the world is if mutual funds were actually traded continuously and priced continuously.
Like an ETF.
Like an ETF, which they could be. And the SEC would just have to approve that. And then mutual funds could be traded all day long instead of at their NAV at the end of the day.
Okay, I have a feeling that's the next thing you're going to be lobbying for then.